we've seen the reasons for the 10 conditions for claiming input tax credit. Let's check each of these conditions one by one, starting with the 6 conditions in reason 1 of tracking or leaving behind an audit trail to check correctness of credit claimed. There are 6. The first one is that the taxpayer has to be registered. The second one, that the supplier has paid tax. The supplier has to actually have paid tax to the government. It could be either in cash or he could have claimed input tax credit, but in one way or the other, the supplier would have to pay tax. This is a very significant condition because in this situation, if the supplier has not fulfilled legal formalities, then you could be penalized. It's unfair, but this is one way that the government is ensuring proper cash flow and proper compliance from all parties involved in input tax credit claim. The third condition is that the business should have actually received goods. The taxpayer could receive goods either physically or through title. What does this mean? It is a deeming clause. The law deems that the taxpayer has received goods if the supplier has delivered goods to him or to any other person on his direction, whether that person is an agent or not, even if before or during the movement of goods, the documents of title have been handed over to the receiver, then it is deemed that the taxpayer has received goods. So transfer of title is also a condition. The fourth is that the taxpayer should be in possession of certain documents. What are these documents? He should have the tax invoice or debit note issued by a supplier registered under this act or any such other documents as may be prescribed. So the supplier will also have to be registered under this act. The fifth condition is that the business should have actually paid the supplier. This is a condition in order to retain credit. If a business has not paid the invoice value including tax amount to the supplier within 3 months from the date of issue of invoice, then the government can reverse the input tax credit given and this credit would be reclaimed from the supplier including interest thereon. Sixth condition under this reason is simple. The taxpayer should have filed monthly returns. If he's not filed monthly returns, then the government will not know how much of claim he's made and will not be able to give credit. So the taxpayer will have to file monthly return and based on the monthly return, the government will grant credit subject to conditions, of course. Why are we calling this as an audit trail condition? Well, let's check that out. In the previous section, we've seen the process involved in tax compliance. There's customer, taxpayer, government, supplier, and the internal processes of the taxpayer. Let's just focus on the part of this process which relates to our conditions. We'll have 3 parties: the government, taxpayer, and the supplier. The first condition is a one-off condition that the taxpayer will have to take registration under the act from the government authority. The second step is where the taxpayer would have placed an order with the supplier for certain goods. The supplier would raise an invoice to the taxpayer and that the taxpayer will have to maintain all such invoices raised in order to claim input tax credit. So that's the second step where he'll have to maintain documents. The third step, of course, is where the supplier has actually given the goods off to the taxpayer, has sent the goods. That's the third step. The fourth step is where the supplier has remitted tax collected to the government. That's the next stage. And the fifth stage is where the taxpayer has filed monthly returns. The sixth step, last step, is where the business has paid to the supplier. Why is this the sixth step? Because in usual business situation, there's always credit involved. You can pay invoices after 1 month, 2 month or 3 month delay depending on the conditions of the invoices. And that's why this condition is a retain credit condition. If you have not paid within 3 months, then your input tax credit claim would be reversed. So in effect, the law is restricting credit period on invoices to maximum of 3 months. So these were the 6 conditions under the first heading. We've knocked all 6 off. We are left with only 4. Coming to the second one under no double tax benefit. This is an easy one, there's just one, depreciation. We've discussed in detail why depreciation benefit cannot be combined with input tax credit benefit in our previous sections. So to state it plainly, the tax lays down that no depreciation claimed on tax amount. Meaning, if you have claimed depreciation, if you have capitalized the tax component on your capital goods, then you cannot claim input tax credit on that particular tax component. And as you can guess, this condition is very specific for capital goods only. You're left with just one more reason of timelines. There are 3 conditions in this. The first one is relating to goods received in installment. It's a simple clause. The law states that if you are receiving goods against any one invoice in installments, then you can claim input tax credit on the entire invoice after receiving the last lot, the last installment only. The second condition is that of claim cutoff. There are 2 cutoff dates mentioned under this. There's a claim cutoff based on invoice and claim cutoff based on return. Based on invoice, you cannot claim input tax credit after 1 year from the date of issuance of invoice. Based on return, there's a cutoff for input tax credit for a particular financial year. We'll get to that in a bit. Let's check out the first one, that's based on invoice. It's a simple one. Say your invoice date is 1st of February 2016. Then the last date for you to claim input tax credit on this invoice is just 1st Feb 2017. Simple condition. The second condition, which is based on return, it's a little tricky, so pay attention. What the law states is that input tax credit for a financial year, that is up till March of any year, from April 2016 to March 2017, so financial year 16-17, the input tax credit for one financial year can be claimed latest till either the monthly return for the month of September of the next financial year is filed, or the annual return for the financial year in question is filed. Whichever date is earlier, that is the latest date for you to claim all input tax credits relating to that particular financial year. A little confusing? We'll go into this in detail. Monthly return. The monthly return includes details of supplies, input tax credit and tax payable or paid, and it has to be filed latest by 20th of the next month. Annual return, which includes consolidated information of all the monthly returns as well as reconciliations, it has to be filed latest by 31st December of the next financial year. Let's take an example to understand this. We'll put the invoice claim cutoff basis as condition 1 and the return basis as condition 2. We'll take an invoice. The invoice date is 1st February 2017. So as per condition 1, the last day to claim input tax credit on this invoice would be 1st February 2018. Coming to condition 2, the last day to claim input tax credit on this invoice, first situation was based on monthly return for September of the next financial year. This invoice is 1st February 2017, so it's relating to financial year 16-17. So September of next financial year would be September 2017. The latest date to file this return is 20th October 2017. The second situation was based on annual return. Annual return for the financial year in question, that would be 16-17. So the latest date would be 31st December 2017. Now, let's analyze the situations. The first situation is where the annual return is filed after the September return. In this situation, the September return filing date would be the last date to claim input tax credit on this invoice. What was the condition 2? Earlier of these two dates. The second situation is annual return filed before September return. Simple. The last date would be the annual return filing date. In both these situations, condition 2 will prevail over condition 1. Why? The latest date for September return 20 October 2017, for annual return 31st December 2017, both of which is before 1st February 2018. So you see, condition 2 will prevail over condition 1 in this situation. We now have only one more condition, and this condition is very specific to pipelines or telephone towers. The law states that input tax credit on pipelines or telephone towers fixed to the ground, either through foundation or through structural support, the claim on input tax credit for this construction would be split into 3 years. First year 1/3, second year 1/3, and the balance claim in the third year or any financial year after second financial year. It's an interesting twist. This is an immovable property because it's fixed to earth by foundation. There's a confusion. Is it an immovable property for own use? Because telecommunication companies, mobile companies would use these towers to remit services. Or is it a movable property? That's a big confusion. So GST has solved that confusion. It has included this particular item in the definition of plant and machinery that we've discussed earlier. Still, it is giving graded input tax credit benefit split over 3 years. And so we've covered all the 10 conditions by classifying them into 3 logical reasons to make it even more simpler. So those are the 10 conditions: registered, supplier paid tax, business received goods, business maintains documents, business has paid to the supplier, business has filed monthly return, depreciation on tax component has not been claimed, goods received in installment, you can claim only after receiving the last installment, claim cutoff based on invoice and returns, and a specific condition for pipeline or telephone towers fixed to the earth.